Even the McDonald's Quarter Pounder is not safe. Apparently, it's being linked to over 40 different hospitalizations across 10 different states, including one death. Yes, the Quarter Pounder. And this news is bringing down McDonald's about 9% in after hours. Starbucks also decided to report bad earnings unexpectedly after the bell today. Starbucks pre-reports Q3 earnings. Q4 full year 2024 results shows consolidated net revenues of $9.1 billion. A change in revenues indicates a 3% decline. Change in comparable store sales highlights a 7% decrease globally. Quarterly dividend is up to 61 cents per share. The CEO says these results reflect challenges in sales and revenue, with a strategic dividend increase to maintain investor confidence. But really, in the grand scope of things, that 7% comparable stores sales number year over year, that's a problem. And it's really highlighted within America. This continues to reflect weakness in the American consumer, and that is a big reason why the markets are down here in after hours. You also have treasury yields that are continuing to move higher in after hours as well. Now, believe it or not, here in this video, we were not going to originally talk about the Quarter Pounder E. coli outbreak, nor were we going to talk about Starbucks, but I figured I would share that at the beginning of this video just so you guys are aware of what's going on. You also have Tyson Foods down about 5%, and this could be a bigger issue for the food and restaurant industry. It could affect the Dow a little bit more, so if you're Dow investors, watch out for that. But here in this video, we're really going to discuss Tesla earnings, which take place tomorrow. I will give you the expectations that Wall Street has, my expectations, and what I think will happen to Tesla stock. Now, I actually do have another video coming out at 10 p.m. Eastern Standard Time tonight, going over Paul Tudor Jones' warning about the American economy, that we're essentially going broke, we're probably going to see more inflation, and higher bond yields, and that is an issue for equities. So keep in mind, we're already kind of seeing that happen, and you're starting to get more big-time investors, legendary investors, Stanley Druckenmiller, now Paul Tudor Jones, that are spreading this idea of higher bond yields, and that pressures Tesla directly. But be on the lookout for that video coming out at 10 p.m. Eastern Standard Time tonight. That's a video I think you need to hear. You also have news that the Israel army has completed preparations to attack Iran, and it will take place within days, according to Channel 12 News Israel. Now, keep in mind, this is one of those geopolitical tensions that can have a real impact on our economy, and it comes down to energy markets. Now, oil. It's specifically oil. The Strait of Hormuz controls about 30% or so of the world's oil supply that flows through it every day. Israel is expecting this conflict is going to be a multi-month conflict. So they're expecting Iran's going to retaliate back, and they're going to go back and forth with each other. Now, you've seen today, oil was up to $72.24 a barrel, up 2.38% today. So I think this is one of those conflicts as well that at any time will negatively impact the markets, because the way that oil is priced, I do think there's going to be more risk priced into the oil markets, especially if there is a multi-month conflict. And this is not something that would have a positive impact to Tesla. Believe it or not, yes, Tesla can benefit longer term from oil prices being higher because it's cheaper to charge your vehicle than to fill up your gas tank. But in the immediate term, it's really not good for inflation when oil rises, and it's not good for economic activity. When oil rises, especially if it rises sharply, that creates fears and uncertainties about the economy. Because it's not only does it cost more to fill up your tank at the gas pump, which is like a tax on everyone, it's also psychologically negative because it makes people reevaluate where they're spending money elsewhere. They may not go here and do that if it's going to cost more in gas, right? We've seen a lot of that in 2008. And what you tend to see historically is right before you go into a recession, you tend to get oil spikes. And that's like the last nail in the coffin, if you will, that solidifies, well, a larger problem in the economy that kind of starts the snowball of a recession. Again, because it not only costs more people money at the pumps, but it changes people psychologically in their behaviors, in their shopping habits, and that's the even bigger issue with an oil spike. And if these reports are correct and this retaliation from Iran could be coming within days, keep in mind, Israel says we're not going to have a heads up on when this attack will happen. So it takes like 15 minutes for missiles to go from Israel to Iran. Then that's a bigger problem for the economy than maybe what we previously thought. Again, especially if that's a conflict that lasts many months. But let's now focus on Tesla. I wanted to get some of these risk factors out of the way first, besides Paul Tudor Jones, the warning that was issued, the problem in bond markets that we've seen even, continuing today. We'll talk about that more at 10 p.m. tonight. I think that's also a very important video that you guys need to watch. But Tesla stock reports earnings tomorrow. And as long as nothing crazy happens over the next 24 hours or so, then Tesla will be free to move based on its earnings coming tomorrow afternoon. With that said, Tesla stock closed today at $217.96 per share. It was able to close above this downtrending line of support, okay, where you're connecting the lows that you've seen back in April, that you've seen in August of 2024, and now what you just seen today. This is a good sign heading into tomorrow, but it's not the end all be all. I think with Tesla specifically, before we get into the numbers, it really has to do with the guidance that we get. Okay, not necessarily EPS or revenue guidance or profitability guidance. If we get any of those things, that will, be important for Tesla, will move the needle or whatnot. It really has to do with the next gen Tesla vehicle. As long as the Model 2, let's call it that, is still going to be released by midpoint 2025, Tesla stock will do well. Even if Tesla misses on metrics of their earnings, even if some things are not as good, you will still see Tesla stock go higher, in my personal opinion, as long as you get that confirming guidance for the Model 2 by midpoint of next year. If Tesla delays that to the end of 2025, I don't think that's a positive, clearly, but I don't think that's a huge negative either. If Tesla pushes that into 2026, then that is a much, much larger problem for Tesla, because Tesla is currently expecting, or at least analysts that cover Tesla are expecting, about 30% EPS growth over the next 4 years. If we don't get the Model 2 next year, you're not going to get 30% EPS growth next year. Unless Tesla somehow is able to lower the cost, even more than expected, unless rates do plummet, which that's not happening right now. So that's why bond yields are so important, because they do have a direct effect to Tesla's expected profitability. If rates on the 10-year treasury are going to stay higher for longer, let's use that term, then it's going to really pressure Tesla earnings over the next couple of quarters. Okay, so let's start here with Gary Black. He's posting this to his X account. He says, our Tesla Q3 adjusted EPS estimate is 56 cents versus Wall Street is 60 cents, with Q3 auto gross margins excluding regulatory credits of 14.2% versus Wall Street consensus of 14.9%. The expected margin shortfall reflects Tesla's 0.99% promo rate offered globally, and our estimate that Cybertruck lost an average of 20,000 per vehicle sold across 13,500 vehicles in Q3. While Tesla automotive costs are falling, the downward trajectory in Tesla's auto gross margin, excluding regulatory credits, may continue in Q4, with zero interest rates offered on all Model 3 and Model Y. Wall Street expects Tesla's auto gross margin, excluding regulatory credits, will rebound to 15.2% in Q4 and 16.1% in full year 2025. So Wall Street is expecting auto gross margins will get better in the upcoming quarter, and get even better than that in 2025. The problem here really is that Tesla right now offering these low rates, they're basically buying down the interest rate. So the interest rate on a car revolves around the 10-year treasury, like a mortgage, right? Mortgages revolve around the 10-year treasury as well, because that is the standard benchmark comparable to interest rates. That's why when 10-year treasury yields are low, you get cheaper mortgages, because the alternative, is a 10-year treasury, right? If you're comparing what a borrower should pay on a home, you're going to compare that to a risk-free yield, which is seen as the 10-year treasury, okay? So Q3 was July, August, and September. If you look at July through September, 10-year treasury yields were falling. So almost every day, it was a little bit cheaper to buy down that interest rate for Tesla. Now, obviously, there's ups and downs here, but as a cumulative, 10-year treasury yields fell a lot during this time. They fell from the start of July, from about 4.47% down to the end of August, where the quarter ended, to about 3.91%, actually hitting a low there of 3.77%. So 10-year treasury yields fell quite a bit. That should be good for margins last quarter. So I actually think margins could surprise to the upside for, Q3. But the problem will be rates have went parabolic since the beginning of September. They've went from a low of 3.62% up to 4.2%. That's a huge move. This is costing Tesla more money. So expectations that margins were bad last month and going to improve, or bad last quarter and are going to improve next quarter, in this current quarter, I think those expectations are backwards. Margins were better last quarter, and they're going to get worse in this quarter that we're currently in for Q4. So I think there's going to be a little bit of upset expectations there. I don't know how much Tesla's actually going to guide for auto gross margins. They typically don't give guidance for that, but it's possible that they kind of just tell us expect margins to be a little bit lower via the 10-year treasury yield that has been rising. So I actually think as long as we don't get guidance for that, Tesla's probably going to beat estimates for margins. Now, for EPS, Tesla's probably going to beat there as well. I do think Tesla could come in with like 65 cents of EPS. That's not going to be a crazy huge beat, but I do think there will be a beat there. I think partially that has to do with the Cybertruck. I don't think it's costing Tesla $20,000 a truck to produce that. I think there's probably in the range of $5,000 to $7,000 of a hit to the bottom line for their production on the Cybertruck per vehicle last quarter. That's because they've really started to ramp that production, and I just don't think that's going to be as big of a headwind as some other, investors and analysts are expecting. And look at that phantom candle that we're seeing in after hours. Wow, that was that was looking rough. But if you are an investor in Tesla stock and you're trying to figure out whether Tesla's going to go higher or lower coming tomorrow, excluding the geopolitical problems, the issues in the bond market, assuming none of that gets dramatically worse tomorrow, it will have to do with the guidance again for the Model 2. I think Tesla will reaffirm the Model 2 coming in the first or second quarter of 2025. That is likely going to lead to a rally in Tesla stock, at least in the shorter term. Now, where does that ultimately send Tesla? I think that is a very open-ended question. I think that could easily send Tesla to that 50-day moving average at about $228 per share. It could send Tesla back to $238 per share, where this 20-day moving average is. You could find some resistance around $235. Those are some of the upside levels that I think are definitely obtainable following Tesla's report. The 50-day moving average is about 4.5% away. The 235 level is about 7.5% away, and the 20-day moving average is about 9% away. 9-10% could be easily be doable coming tomorrow in after hours. Again, as long as we get that guidance for the Model 2. Now, unfortunately, I don't think it's going to be a long-lived rally, though. So if you're in the camp of expecting Tesla is going to rally to $300 and go to all-time highs after this earnings, I don't think that is realistic. And I'll tell you why. I think we're heading for a correction. I talked about this in the last video that was posted late last night, 2 videos ago actually. But the problem really is the bond market is screwing the rest of the markets, okay? If you look at the RSP has started to come down in a pretty significant way. Even today was down about 0.5% because of the pressure 10-year treasury yields are starting to put on the markets, as they are now above 4.2%. It looks like 4.2% is a pretty critical level for 10-year treasuries to start affecting equities. Now, this whole time 10-year treasury yields have been rising, stocks, generally speaking, the broader markets were doing well. Now it's starting to flip-flop. Now it's starting to actually affect the markets in a negative way. So I don't think we can expect a broader market rally to come. I think 10-year treasury yields are probably going higher, closer to about 4.5%, even here over the next couple of weeks. But we also have Apple Intelligence that is expected to launch next week, and that's going to be a disappointment. It is. You're not going to get this massive refresh cycle, people running out to go buy the iPhone 15 or 16 to just be a part of Apple Intelligence. I don't think consumers really care that much at this point about Apple Intelligence. And the expectations are so high that if this thing does flop even in a slight way, that's going to bring up a whole lot of questions on how other big tech companies are trying to bring AI to the mass market. Like, is AI going to take time to actually adopt into society? Are people just going to run into AI products like they did ChatGPT? That's going to be the bigger problem. Whether or not that is what happens or not, Wall Street, I think, is going to take a moment and say, maybe big tech should slow down some of their CapEx investments into AI. Because maybe it's going to take 5 or 10 years for the average citizen, the average consumer, to adopt some of these AI products. That is a problem. Now, I think in a baseline scenario, 10% correction could be all. In a more dramatic scenario, where Apple Intelligence is a complete flop, it does nothing, people react maybe negatively to Apple Intelligence, then you're going to be looking at a lot of doubts whether these big tech names should be investing this much into AI. Think about the metaverse, right? In 2022, Meta was trying to develop the metaverse. They were spending a lot of money to do so. They were spending a lot of money in other areas, just basically throwing money down the drain. Wall Street did not like that as the Fed was raising rates. They punished Meta stock from that. It was actually one of my best trades of all time. It was $500 into $25,000 on one of Meta's earnings. And the stock got destroyed. So I think from that perspective, that's kind of what you could start to see in the markets. The marketplace, investors starting to punish companies that are over-investing in AI that are not going to be able to justify any return on that investment. Now, I know I'm early on this. I know it's going to take some time to get the data out from Apple Intelligence, consumer kind of responses, the whole shebang. It's going to take probably a couple of weeks. But that's a big problem for markets, and that could be a big problem for Tesla and really everything. If big tech were to sell off, I think the rest of the markets are going to sell off at that point, because there's no support for a broader market rally when 10-year treasury yields are rallying the way they are. So I don't think we can even count on a rotationary kind of correction, right? Where big tech sells off, rest of the markets catch a bid. It's going to be hard for the rest of the markets to catch that bid if 10-year treasury yields are doing what they have been doing. So I think from that standpoint, you're probably not going to see some large continuation rally with Tesla, but I do think, at least in the short term, over a period of at least a couple of days, Tesla's stock could move higher. It wouldn't surprise me if Tesla even went back into the 250s or 260s, at least short term, but I would not expect that to be a durable, lasting, sustainable rally, whatever terminology you want to put on it. But I am fairly confident Tesla stock is going to give us exactly what we want to hear. Now, Tesla's not priced for like super great news on Tesla earnings. Expectations are pretty damn low. The bar has been set low for Tesla. It's been set low for basically any company reporting earnings these days. So from that standpoint, it's going to be easy for Tesla to impress Wall Street. So short term, I think Tesla's going higher. But don't be confused. Don't get faked out. I do think Tesla is probably going to go lower alongside the broader markets over the next 6 weeks or so. I posted the video 2 videos ago last night that you're going to get at least a 10% correction, in my personal opinion, within the next 6 weeks. It's going to set you up with a much better entry point for Tesla, in my personal opinion, and set you up for a better entry point in other stocks as well. So I think you would want to take advantage of that as long as the economy is not plummeting into a recession. Starbucks earnings don't give me a lot of confidence that things are great out there. So that's a very tentative question. I don't have the answer to that. Things don't look great right now. But we'll see how the data comes in and the rest of earnings season comes in over the next couple of weeks. Long story short, be ready to buy the dip in Tesla, but not for a couple of days. I think Tesla's firmly going higher after they report earnings tomorrow, unless they delay the Model 2, which I see as unlikely at this point. But if Tesla does delay the Model 2, then I would expect at least 10% downside for Tesla. And keep in mind, Tesla has a history of falling like almost exactly 10%. 10 to 12% over the past, couple of quarters they've reported. So yeah, you usually fall like 10%. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.